Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from Palm Springs in the greater Coachella Valley area. We're winding down our season, if you will, about to go into our third week of the music festivals, this week being Stagecoach this weekend. And then, of course, after that, folks here tend to get out of Dodge and the locals stick around and get ready for our toasty summertime. So great weather today, nice sunny, a little bit blustery day, but all in all, a very good day, all from all perspectives. I want to go ahead and get right into our program as it relates to mortgage rates and the bond market. First thing we do is bring up the rate grid from our website, where we try to maintain current interest rate indications. And I keep saying it's a broken record. Mortgage rates, despite all of the dismal headlines and the volatility in the financial markets and the stock market and the bond market and so forth, mortgage rates are still hanging in there. We're still in the sixes. We're still in the mid sixes, and I'm going to touch on that here a little bit more in a minute. But you can see right there, I mean, conforming conventional 30-year fixed still at 6.5. Our equity loans, in particular, I'm going to talk about this a little bit later in more detail. Equity loans, in particular, fixed rate equity loans, what we call HE loans, are right now a very good deal. So those of you thinking about a HELOC, you might want to consider that HE loan. You can actually get rates under 8% with no points. And if you're willing to pay a point or two on a HE loan, you can actually get a rate, believe it or not, in the sixes. That is just tremendously good when you consider conforming first mortgages are in the mid sixes anyway. Again, we'll talk about that a little bit more. So again, rates are hanging in there. They're not, going way up at all. They seem to be pretty darn stable. And again, the other thing we like to do is show you what the 10-year bond chart looks like. This is a 5-day chart. Remember, it goes back to last Friday to today. And you can see there with a little bit of a dip on Wednesday, late Wednesday, it's been relatively stable with a little bit of a decline here from Wednesday to now. So 432, we've been in that range now for a good amount of time. So as a consequence, that's why mortgage rates continue to be where they're at. We're going to need to see the bond yield get back down to closer to 4 or under 4 to see a significant improvement in mortgage rates and maybe get under that magical 6% level. So again, the basic idea here is mortgage rates, despite all of the volatility, all of the horrifying news about the tariff trade war and the stock market up 1,000 points, down 1,000 points, we're hanging in there pretty good on mortgage rates, and I think that's a good thing. So let me touch on a couple of things in terms of economic data points and so forth that support where the rates are right now. It was actually a very light week with data points again, not much to report on, but I thought I'd show you a couple of things that you might be interested in. One is new home sales. Believe it or not, new home sales went up in March over February. That's a bit of a surprise. Most home builders have been kind of moaning and groaning about the fact that sales have been somewhat slow. But I think if you peel the onion on this number, I think this is reflective of the fact that home builders in particular, not so much on the existing home sales side, the new home sales side, home builders are extremely aggressive right now in offering incentives to get their homes sold. Something I keep talking about and keep hoping that I can, sort of convince more realtors and sellers of private homes, the existing home market, to consider the same strategy. In fact, just an anecdotal example, I had a real estate agent I do quite a bit of business with. Well, she ended up taking a prospective buyer to a new home site. The builder is actually D.R. Horton, and that's here in our local market. And D.R. Horton, of course, is in the mortgage business. They have a mortgage division. And so the agent showed me their quote, a written worksheet. It asked me if I could compete. And of course, she pretty much already knew I couldn't. And the reason why? Because the incentives that were offered for this particular buyer were tremendously good. Consider this, an FHA loan, 30-year fixed at 3.99. The current FHA rate's right around 6.1. So $399, that's a 2% permanent buy down. And in addition to that, the seller, D.R. Horton, was offering $7,500 credit toward the buyer's closing costs. That is a tremendous incentive. In fact, it's got me scratching my head a little bit, because if you do the math on that and the way FHA loans loan rates are priced right now, that almost looks to me like that builder is providing concessions that exceed the 6% limit that FHA loans allowed. So I'm not sure what's going on there, but it's, again, an example of what builders are willing to do to move their inventory. Now, how about compare that to the existing home sale market? It was forecast to be 4.13 million in March, a drop from 4.26 million in February. Well, that number came out today, 4.02 million. It came in below forecast, and again, a fairly good amount below February. And in fact, that number for March of 2025, 4.02 million of existing home sales, is the lowest it's been since March of 2009, as we were coming out of the Great Recession. So that is a sobering number. And frankly, in my local market here in Palm Springs, Coachella Valley, talking to a lot of real estate agents who are somewhat complaining about there seems to be this sudden lack of buyer activity, and they're holding open houses, got listings where they're starting to get a little bit more aged, if you will, in terms of days on market. I don't attribute that so much to interest rates. I attribute it more to people being a little bit nervous, again, with all the trade war talk and headlines. And of course, the wild swings in the stock market has certainly affected the wealth of a lot of people and families. And I think that probably has more to do with the fact that some buyers are choosing in this volatile period to kind of hold steady and kind of wait for things to settle down. But in that respect, I think that provides an opportunity, which again, we'll talk about a little bit later when Jeff gets on this show and we go into our discussion phase. The other thing I wanted to show you is there's been an update in mortgage rate predictions for this year and beyond. So I wanted to list them here for you so you can kind of get an idea. NAHB, that's the National Association of Home Builders. They're forecasting 6.5% at the end of 2025. Interesting, because that's where we're at right now. And then 6% at the end of 26. NAR, National Association of National Association of Realtors. Their prediction is 6.4 by the end of 2025, and then 6.1 at the end of 26. Fannie Mae, the Federal National Mortgage Association, 6.5 at the end of 25, 6.2 at the end of 26. Freddie Mac, Federal Home Loan Mortgage Corp. They didn't even put a specific number in their latest release about interest rates. They simply said they're going to stay higher for longer this year. And of course, that's part of our mantra, as you can see at the bottom of the slide. And then lastly, the MBA, the Mortgage Bankers Association, their forecast 6.5% at the end of 25. So I think you got a message there. We're going to be in the sixes, very likely for the balance of this year and probably for most of next year. So for those of you waiting, hoping for that magical drop in rates where we're going to get into the fives, or you're really hoping that we might get under 5 into the 4s, that's not on the horizon anytime soon, at least not in the next couple of years. So I think you just need to, kind of embrace that and realize we are where we're at in terms of rates. And of course, if you remember on our program here a week or two ago, we talked about the Mortgage Rate Affordability Index, that economic firm that came up with this calculation to evaluate mortgage rates as to both where they are at currently versus historically. And if you remember, 50-year average 7.7. If we're in the mid sixes, that actually means that current rates are affordable from a historical perspective. Now, there's other issues as to why it's tough to buy a home right now, but I would argue rate isn't the biggest culprit. There's other factors involved. So with that, I want to go into a quick comment about what has kind of evolved into a pretty good opportunity. ARM loans are starting to get a little bit more attention in the industry, in the mortgage industry, and in general in the financial industry. Frankly, I haven't originated an ARM loan in about 5 years. ARM loans have not been a major part of the mortgage industry for quite some time. The rates on the rates on them simply haven't been that good when you compare it to 30-year fixed, even with the increase in the fixed rates that we've seen in the last year or two, or a couple of years. But there's been a recent shift in market conditions that are creating an opportunity. Now, that opportunity, oddly enough, is specifically associated with the FHA 5/1 ARM. So that's what I want to tell you about a little bit. FHA ARMs right now can offer rates 0.5 to 1% below a 30-year fixed. Conventional ARM loans, not so much. The spread between a conventional ARM start rate and a conventional 30-year fix is still pretty narrow. But FHA, it's getting pretty wide just based on what's going on in the financial markets. And the thing about the 5/1 ARM, let me explain what that means and how it works. An FHA 5/1 ARM, what that means is you're going to get an initial interest rate that's going to be fixed for 5 years. At the end of 5 years, the one in that description, 5/1, the loan will then adjust annually every year, once a year. So a 5/1 ARM fixed for 5 years, then it adjusts annually every year, once a year for the additional 25 years to get to the full 30-year term. Now, a conventional ARM, just as a point of comparison, they work a little bit differently. Conventional ARMs, the most common ones that are offered today are fixed for 5, 7, or 10 years. So that's good. I mean, those are part of the reason we call them hybrid or fixed ARMs, because you have a good fixed period that can be as much as 10 years. But with a conventional ARM, the standard core product that's available today, they adjust after the fixed period on a semi-annual basis every 6 months, not every year. I would call that a less desirable adjustment schedule than the 5/1 ARM that the FHA offers. More frequent adjustment intervals means a potential of more frequently seeing the rate go up in a rising interest rate market. But of course, at the same time, if we have a lower interest rate market trending, then you maybe get to take advantage of that more often. Now, the key thing to look at when you're looking at these ARMs, and this is where I think the FHA ARM has a great advantage over conventional ARMs, are the caps. Okay. Now, the caps with the 5/1 FHA ARM, they are what we call 115. Okay. 1% the first adjustment. So you have the loan for 5 years, and then in start of year 6, you can have an adjustment in your interest rate, but based on the index, which FHA loans are tied to the 1-year constant maturity treasury index, plus a margin added to it. That sets the rate for the 6th year. But if it causes an increase in your fixed 5-year fixed rate period, you're capped on that increase at only 1%. So you cannot go higher than 1% above your start rate, even if the index plus margin is higher than that. And then each subsequent adjustment is also 1 year, again, for the entire remaining 25 years life of the loan. And then it has a 5% life cap, meaning if you start at, say, 5.5 on a 5/1 ARM, your life cap means you're not going to ever be higher than 10.5. Now, a conventional ARM, the caps are different and not as good. A conventional ARM, the standard caps are 515. And here's the scary part. Let's say you get a conventional ARM with a 7-year fixed period. Well, that's good. You get an extra couple of years. But then when it adjusts in year 8, if the index plus margin, now with the conventional ARM, the index is the secured overnight financing rate, what we call SOFR. That's actually, and then a margin is added to that. If you're fixed for 7 years and then the index has to be, or the rate has to be adjusted in year 8 based on the SOFR plus the margin, the increase in that 8th year can be as high as 5% over your start rate. That's huge, right? And then after that 8th year, I shouldn't say the 8th year, the first adjustment in beginning of year 8, the adjustment is going to occur. If there's an increase required, it's going to be capped at up to a 5% increase, which is substantial. And then it's going to adjust again in 6 more months. And then those adjustments starting after that year 8, first 6 months, then every 6-month interval after that, it is a 1% adjustment cap, and you do still have the same 5% life cap. Although again, conventional ARMs typically are going to start more like the higher 5s and the 6s, so your life cap is probably going to be 11% plus. Now here's the key difference with the FHA 5/1 ARM and why I think it's a huge opportunity for those borrowers who need a FHA loan, whether it be for qualifying purposes or maybe as a rate play. The conventional the FHA 5/1 ARM qualifies at the start rate, at the note rate. That is not the case with a conventional ARM loan. With a conventional ARM loan, you are not going to qualify at the start rate. You're going to qualify at the fully indexed rate. That means the index plus margin, or the note rate plus 2%, whichever is higher, except if you take a 7/6 or a 10/6 ARM, which of course those have a higher start rate than a 5/6 ARM. So that's a key difference. That's why if I'm talking to an FHA buyer and we're quoting them, 6%, 5 7/8, and we're running into a debt ratio problem, a 5/1 ARM can be very helpful, because we do get to qualify at that lower start rate. And if the lower start rate is, say, 5 1/8 versus a 30-year fixed FHA at 6, that can make a very significant difference in the borrower's ability to qualify. So I just want to bring this to people's attention that the 5/1 ARM right now is a great opportunity from a rate perspective. And so I'm spending more time now when I'm pre-qualifying buyers who need FHA or want FHA, bring this to their attention so they understand the rate opportunity. Now, an ARM loan, of course, has some risks involved. What happens to your rate and payment when the adjustments start after that 5-year period? What I would say to that is a couple of things. Number one, in a lot of cases, the 5/1 ARM or any conventional or FHA ARM is going to work best or be suited best for a borrower who maybe has a pretty good idea they're not going to need the loan or keep the loan or the house beyond that fixed period. But even if they choose to keep it past that fixed period, you want to understand that these loans are not designed to automatically go up. They can go down. And we have seen in certain environments, like earlier in this decade, the 2020, 2021, those who had hung on to ARM loans that they got maybe 5 or 6 or 8 years before that actually saw their rates drop because of rates in general falling. So again, I want to bring this to everyone's attention. The 5/1 ARM is becoming, I think, a very good product alternative to look at if you're rate sensitive and if you need it for qualifying purposes. So if you have any questions about this product, if you'd like to get a worksheet on this product, contact me. I'd be happy to put some numbers together for you and get them to you so you can evaluate this along with your other mortgage program options to consider, especially if you're buying a home. With that, I'm going to go ahead and bring Jeff in so we can start our discussion on a few different topics as it relates to what's going on in the mortgage business right now. Hey, Jeff.
Hey, Art. Well, Art, I'm just curious that the 5/1 ARM or adjustable rate mortgages, as you said, that really hasn't been very popular in the last few years. Why is that the big three reason for? I know you touched on it just to satisfy my appetite. Why has that been something that's not been used?
Well, it gets kind of technical, but I think what's going on is in the financial markets and bond market and so forth, there's a lot going on. There's this fear of inflation has sort of been reignited because of the tariff, all the tariff stuff. And so I think what's happening is when you take a loan that's designed to have a shorter fixed period before it starts adjusting, that relatively speaking allows for the pricing on that loan to be advantageous to one that's just being priced as a 30-year fixed term. 30-year fixed term loan, it would be considered more risky if we end up in a higher inflation environment. So I think as a consequence, that's why this opportunity has arisen. I have one particular wholesale lender who's really promoting this, and I'm not seeing a lot of the lenders that we do business with doing the same. We're signed up with about 16 lenders, and I've been pricing out the 5/1 ARM product here the last few days. And I've got one particular wholesaler who is substantially better in pricing this product than most of the other lenders that we do business with. And I think it's because they've seen this opportunity and they're trying to make it known to their broker network, and for us brokers to let it be known to their prospective buyers that this is a good product to consider. In fact, my account executive at this particular wholesale lender, he's telling me half his loan volume right now is FHA 5/1 ARMs.
Wow.
Which is crazy. I mean, again, I haven't originated and closed an ARM loan since I think 2019. And because ARM loans simply have not been competitive from an interest rate standpoint. This particular product is kind of going against the grain in that respect. Plus the fact the caps on this product are incredibly good. 1-1 caps is terrific. I mean, that is much more protection for the borrower, for that borrower who chooses to keep it past the 5-year period, than the conventional ARM products that are out there. That plus the fact you can qualify at the start rate, this can be a very good option. We've been talking a lot about temporary buy downs, where you have to negotiate a concession from a seller in order to fund that temporary buy down. Well, what if you've come across a house you want to buy and the sellers dug in, they're not going to offer any concession, and you decide, and we've determined you need an FHA loan. Well, here's a way to get some relief on the rate without getting help from the seller to do that. Again, it depends on the borrower, what their future plans are. I spend a lot of time explaining the pros and cons of ARM loans, what the risks are. I want to make sure that borrower understands what they're getting. But if we go through that process and they're comfortable with it, this can be a great way to get very good relief on the rate without getting help from the seller to achieve that.
I think that is a great motivator, if you will. It's not like I have to, I shouldn't say, as you say, negotiate some concessions from the seller. But the other thing that caught my eye or my ears as I was listening to you go through this is the temporary buy down. You have to qualify at the high rate, correct? But in this case, I get to do it at the starting rate. Is that right?
That's correct. Yeah. That, again, we've always tried to be very clear about temporary buy downs are a great tool. We promote them quite a bit, but it is not a qualifying tool. You don't get to qualify at that subsidized rate that first year in a 3-2-1 or the first year on a 2-1. You don't get to use that lower rate to qualify, and it's not used to calculate your debt ratio. The note rate is used to calculate your debt ratio. The FHA ARM, the 5-1 ARM, not so. Even though it's only fixed for a 5-year period, you get to qualify at that start rate. Conventional 5-1 ARMs or 5-6 ARMs do not do that. The conventional agencies believe that a 5-year fixed period is too short, and therefore it's too risky to qualify the borrower's ability to repay on that first 5-year lower rate. So as a consequence, they've got that formula that we have on the screen, where you're essentially, if you're getting a conventional 5-6 ARM at 5 7/8, you're not going to qualify at 5 7/8. You're going to qualify at the index, the SOFR index plus the margin, which right now today is more like 7%. So a 5-1 or I keep saying 5-1, a 5-6 conventional ARM, your ability to qualify is actually more difficult because you don't get to qualify at that start rate.
Just to kind of go through that again, or maybe talk about a little bit more in depth, is who is really this product designed to help the most? Where's it an opportunity for somebody thinking, hey, I'm a buyer? What does that buyer look like? So you can help identify them. So if they're listening and say, oh, wait a second, that's in our case.
Well, it's a few things. Number one, as I mentioned, well, first of all, I will tell you, as I've gotten the pre-quals I get all the time, I'm noticing more often I've got prospective buyers saying, hey, tell me about ARM loans. Is there any opportunity to get a better rate with an ARM loan? So I'm hearing more of that from people looking to buy a home. So you have to start with that. If you're being asked about it, we got to provide a product that meets that inquiry, that curiosity, if you will, and show them what's available. So I'm getting more inquiries about, tell me about ARMs. Are they an opportunity right now? So that's one thing. Once I pre-qualify somebody, and again, if we determine FHA is the best product for them to use, I'm then going to determine, are they going to be okay with that 30-year loan, or do they need some help on debt ratio? The FHA ARM will directly address that and help them qualify when they otherwise may not for a particular loan amount. So that's important to understand. And then one of the things I try to stress is this type of product works best for somebody who has a pretty good idea what they need for the next few years, obviously for the next 5 years in particular. Are they going to be in a situation where maybe they expect an inheritance in a few years, where they're going to get enough money to pay off that loan and not even deal with the adjustments when they start in year 6? or maybe they are aware that they're in a local market, they need to buy a home, but they already know that maybe they're on a 3-year assignment with their employer and they're going to be relocated. That could be another reason why you would say, well, why wouldn't I take a 5-1 ARM versus the 30-year fixed rate? Because the rate's better on the 5-1 ARM, and I already know that I'm probably, in fact, very unlikely going to need the loan after 5 years. So that's the kind of scenarios where this kind of product can be a very good alternative. And like I said, again, it's a good option that we're now starting to present to anybody who is kind of balking at current rates. And we want to therefore show them there is another option if you understand the trade-offs between the fact that I can get you a much better rate, but that's not going to be in place for more than 5 years before it starts to change. And I've said before in the show, most mortgages, particularly in California, tend to pay off within the first 5 to 7 years anyway, for a variety of reasons. And so this product is kind of consistent with that phenomenon, and therefore it can prove to be a pretty good option for a lot of people.
Well, Art, are those people who, let's say they do have a 3-year assignment, they took the 5-1 ARM, if they pay it off, let's say they sell their home in that, let's say the beginning of the 4th year, are there any prepayment penalties or anything of that nature?
No.
So
No.
really
Any conforming loan these days, whether it's conventional conforming, FHA, VA, there's no prepayment penalties. Those are not an allowable feature anymore. And of course, the other thing I didn't point out is, people refinance much more frequently than they used to. So if you've got a 6% rate for an FHA 30 and you can get a 5-1 ARM at 5 1/8, some people, if they're a little bit more willing to risk or take risk, they might say, well, I'm going to take that lower rate because I think there's a pretty good option or pretty good opportunity that rates are going to fall in the next 5 years, and that'll give me the opportunity to refinance this loan into a lower 30-year fixed before that 5th year is up and the loan starts adjusting.
So this is not just for new homeowners. These are the people that say, hey, I'm in a situation right now where my rate is higher than the 5-1 ARM. I can refinance into that?
Yeah, sure. I mean, that is another option as well. In fact, that's a good point, is that, anybody who got an FHA loan here in the last couple of years and they got rates that are being 6.5, maybe 7%, refinancing into an FHA 5-1 ARM where maybe you could take 2% off of what you're currently paying, that's another opportunity. So yeah, it doesn't have to be just for a purchase. It can also be a very good option for somebody who's got an existing high rate 30-year fixed, and they want some rate and payment relief, and they're betting on the fact that within that next 5 years, they'll be able to refinance again into a lower fixed rate when the conditions present themselves.
That's fantastic. Well, your information is on the screen. 760-969-5023 is Art's office number. You get a hold of him, or you can drop him a line at art@mwloan.com. Thanks for that information, Art. I just wanted to go through that before we got into today's topic. This is my fun part. I get to have fun with the thumbnail here. Is it really chaos out there? What about buyers and sellers? And, what advice do you have for them? It's kind of like, you always talk about beware of the headlines, and boy, we are living in that. It's like walking in a minefield because every headline is designed to get you and trigger our emotions. When you start peeling back, you're going, hey, wait a minute, that wasn't bad news after all.
Right.
So I wanted to kind of talk about that a little bit today, and let's start out with news for home buyers. Where are the prices going right now?
Well, generally, the prices are holding firm and they're still going up, again, albeit not as briskly as they were, but they are still trending upwards, at least in most markets. Again, remember just a few weeks ago, we presented the latest Case-Shiller index numbers. And of course, they showed, I think, year over year, home prices still went up. Again, it's a national number, but I think a good indicator. Still had gone up year over year about 4%. So prices are still creeping up, but not as substantially as they were certainly during the pandemic. So to me, that begs for the fact that if you're not, looking to buy a home yet, you ought to be considering that, because if you keep waiting, they're only going to get worse, I think.
Well, and you've also talked about, inventories. We've heard Barbara Corcoran talk about it. We've heard everybody talk about it. It's like, it's going to be a long time before inventory levels are such where it's like normal.
Right.
So where are the inventories right now? Are the inventories high? Are they normal? What's the situation there?
The inventories, and I'll speak to my local market here, but I think this is generally true in most markets, certainly in California, if not the entire country. Inventories are higher than they've been, but I would say they're not higher to the point that we're in a normal market. Again, normal has been historically been okay. We need 6 months of inventory based on the current sales rate. That's normal. And there was a period of time, as you know, we've talked about it before, last year and earlier, where inventory got very low, like, 2 month supply or 1.5 month supply. That certainly has changed. Inventory now has creeped up to where it's more like 4 to 4.5 month supply based on the current sales rate. And of course, with this new existing home sale number that just came out, you just do that math equation. With that lower 4.02 million of the existing home sales, that lowers the sales rate. So even the inventory today, if it stays where it is, that will cause the months of inventory to be slightly even higher because the sale rate has slowed. And yes, I mean, the thing about, I think, the current conditions is prices are still creeping up, inventory is creeping up. We do have all this turmoil in the financial markets, all these crazy headlines, scaring the what out of folks. I think it's causing a lot of home buyers, and this is what I'm hearing from realtors, that they're getting whacked on their 401k, and there's this fear that inflation's coming back, although the most recent numbers don't suggest that. What I think this means is there's a window of negotiating power that is opening, and so for those buyers who've been on the sidelines, I think you're missing the underlying opportunity that, despite all this chaos and volatility, turmoil, you have what has been developing and is opening a negotiating opportunity that we haven't seen in quite a long time.
Well, I look at this as, does this mean better opportunities for people for buy downs? We've already talked about the FHA arms, but both temporary and permanent, because you brought up in the last few weeks about the permanent buy downs that you've actually shared with people and helped them get versus a temporary. Do you see that opportunity growing for people?
I do, because again, with this negotiating opportunity opening up, there's a few things to consider. You now have a better opportunity to negotiate the price. Now, you can negotiate the price just by asking for a price lower than the list price. That's an option. I've, of course, been very vocal about the fact that I don't think that's the best option. The other option is negotiate seller concessions. That's where the buy downs come in, whether it's temporary buy downs, permanent buy downs, or closing costs, or a combination of those. And then the other thing is, I think with the current environment, there's less, not gone, there is less phenomenon of bidding wars going on in a lot of markets. And so that gives you, as a buyer, a little bit more opportunity to be, more choosy. You don't have to be quite put in the position where you have to hurry up and, submit an offer, try to, compete with multiple offers. There's a lot less of that going on. So you have that opportunity to be a little bit more choosy, and to be less inclined to just like what we were seeing a couple of years ago during the pandemic, where you're waiving all contingencies because you got 15 people you're competing with on that house. That is now a very, very small part of current activity, and that's why you can be more choosy in terms of finding the house you want to buy, and not being inclined to have to waive all contingencies to do it. So the point of that is, it's less likely in the current environment that you're going to be subjected to bidding wars like we all saw a couple of years ago. Now, that's not to say they don't happen. I've got a loan in process for a home up in Brentwood, California. And I don't mean Brentwood, LA. I mean Brentwood, Northern California. And it was a PUD, single family detached home with HOA dues. And our borrower, the home was listed at $600, which is a very good price, right? Relatively speaking. But she had to bid. She ended up getting the house, but she had to get up to a 640 offer before she got
Wow.
it. We're closing a loan tomorrow on an oceanfront property in Sunset Beach here in Southern California. $3 million loan amount. The property is being purchased for 4.5 million. And our customer, our borrower, prevailed in getting the home, but he competed against 5 other offers. So there is some of that going on. But overall, I would say you've got a lot better negotiating opportunity that has opened up, a lot less bidding war phenomenon going on, and more of an ability to negotiate concessions either in terms of dollar credits for buy downs and closing costs or a lower price. So I think the current conditions, despite all the headlines and the awful news going on, this is actually a pretty good opportunity, a pretty good time that prospective homebuyers should be considering.
Well, do you see any particular segment of the housing market that is hotter than the other in a positive, like, hey, this segment seems to be moving better than this segment? Have you noticed any of that?
Well, exactly. And of course, this has been going on for a while. What I see and what I've heard from agents in particular, there's sort of a divergence in terms of where the activity is. And again, I'll use my local market as an example. $1 million plus, pretty good. Activity is pretty good. Prices are holding up pretty well and increasing in some markets. Then the lower end, more first-time homebuyer product, which, these days, we in the old, not too far in the past, a first-time homebuyer home might have been 300,000 or 400,000. Well, now it's more like 500,000 or 600,000. But the point of it is, at that lower end, activity is pretty good. The demand is there. What I'm hearing is the spot that's kind of lackadaisical is that 600 to a million range, or 700 to a million range. That segment seems to be more in the doldrums than the $1 million plus or the 500 or less.
Well, I did see something that was, I tend to, because of you, I tend to look at things like my 10-year every day, sometimes several times a day. And then also, what's new listing on the market. And I saw in the La Quinta Cove area, the area, in the Coachella Valley, I saw for the first time, I saw one of those starter homes, like 1,250 square feet on a 5,000 square foot lot for $399. That caught my attention. Like, oh my gosh, I haven't seen that range of a price unless it was a massive, fixer upper, which this one didn't appear to be. And I thought, I wonder what's happening. And I did see a lot more homes on the market in that particular area. So I thought that was interesting. So I was curious if that market is softer or, what's going on there. So that sounds like that makes that first-time home buyer an opportunity there.
Yeah, I would predict that $399 listing, if it's in good shape, it's going to probably get more than one offer.
Well, let's jump over to the homeowners, because it's curious with, again, all this chaos. Are there some opportunities there? Is it time for them to move, or should they stay put if they're a home buyer, right? Or if they're a homeowner right now?
Well, that's an interesting question to answer, because I would say the conditions right now are good for either. I do believe that even if you do have a home that where you've got a 2.5% or 3% mortgage, and if that home is worth 50, 80, sometimes double what it was if you've owned it, say, before the pandemic surge in prices that occurred, you may have substantial amount of equity now. And if that home is no longer meeting your needs, I think it's not a bad idea to consider giving up that existing low rate and sell to get into a bigger, nicer home, or maybe a different location than where you're at now. I don't think that's a crazy idea, but that's not to suggest that most home buyers or most homeowners are still kind of feeling like they're trapped and they don't want to give up that rate. Okay, if you don't buy what I just said, you certainly at a minimum ought to be considering that equity and doing something with it, especially if your existing home isn't meeting your needs. And you need to do some things to it. If you're not going to sell and buy something else, then what can you do with that existing home to essentially convert it into more than what you have now that's going to meet your needs, particularly if your family's growing and things like that. So I think because of that, I don't know. I mean, I can't understand why somebody with all that equity, if they have a need for that cash for a variety of reasons, wouldn't take advantage of that now. Now, the standard core product to do that has always been the HELOC, the home equity line of credit. And what I've actually seen with home equity lines of credit is the rates on those have actually creeped up a little bit. And I think part of that reason is that inflation fear in the markets about, the trade wars, the tariff situation is going to cause inflation. So if you're talking about a variable rate loan like a HELOC, that's going to be a factor in terms of the rates going up on that. And so as a consequence, the starting rates on those is not as good. The opportunity right now are what we call home HE loans, home equity loan. It's a fixed rate product, 30-year, 20-year, 15-year, 10-year term. Those right now have a relative price advantage that is significant compared to a HELOC. And in fact, the last three equity loan inquiries I got that we're processing now, I showed the homeowner both options, HELOC and HE loan. All three of them took the HE loan because it was a better rate play. And they concluded they didn't really need that feature of being able to pay down the HELOC, reuse it in the future. They had a specific need that they're going to use the money for. And they felt like they were better off taking the HE loan because they have this one-time need. And as a consequence, they'd rather have a fixed rate, certainty of rate and payment. In fact, one of the ones that we're doing is I've got a homeowner. I've done many loans for him over the years. We're doing a significant, over $250,000 HE loan to pay for his son's college tuition.
Okay.
And in this case, he learned from the university he's going to that if he paid the tuition up front for the whole 4 years, gets a discount.
Wow. Okay, good.
So he's getting a HE loan to do that. And frankly, that's a great idea. Makes total sense.
I love that. Well, I was just curious, if now is a good decision, to pull equity out for things like, a remodel project.
Oh, for sure. In fact, I've got a list here of things that, can be considered. Remodeling is a good idea. You want to make sure if you're going to do a remodel project, don't get into like what I would call vanity improvements, where you're just trying to make it look nicer. I mean, do remodel projects that are going to add value. I mean, for example, energy efficient upgrades, kitchen or bath remodels, roof replacement or foundation repairs, adding an ADU. Those are all things I think will have a payback in terms of adding to your value over time. And so I think that is a very good reason to consider a HELOC or a HE loan.
One of the things I noticed is, if you have a credit card debt, those rates have seemed to gone up quite a bit. It's crazy when, they send you these, introductory offers. Then when you look at the back, it's like, oh my gosh, 25 and 30%. Is this a good play to take that HE loan that I noticed when you first started today, the rate is under 8% to pay off some of those higher interest debts?
Well, exactly right. In fact, here's what's kind of crazy. I've encountered homeowners who come to me for an equity loan. And again, most people, I think, have become conditioned when they call for an equity loan. It's always, I want to find out more information about a HELOC. The HE loan doesn't seem to be in the conversation with a lot of homeowners. And what I find in some of those inquiries is the reason they're looking for one finally is because they did some sort of remodeling. Maybe they did a new kitchen or bathroom or something. And then what I learned is they decided to use credit cards to finance that.
Ouch.
Now, and of course, then their thinking was like, well, I had the credit limits available and it was a quick and easy way to get the work done. But then they're like suddenly realizing, oh my gosh, I got $55,000 on my credit cards at 25% interest. What the heck am I doing? So obviously, if I can arrange a HE loan, which I can, for somebody who's done that, and I can get them a fixed rate and loan for, say, the 20-year term, by the way, is the sweet spot for pricing, and get them a rate at, say, 8% or below, how could you not do that? And
that's got to save a ton of money.
Yeah, and it's a fixed rate loan, so you don't have to worry about if all this inflation is going to go back up kind of talk that's out there, which of course would mean likely that mortgage rates will creep up, not down. Well, if you've got that loan fixed at say 8% or 7.8, you don't have to worry about that. And you've reduced your interest cost by what? A third? Well, no, by 2/3. I mean, that's a no-brainer. Why would you not do that? And I think there are people out there who are in that situation, whether it's because they did remodeling or they just were living well, and they, I've got some people I'm doing loans for right now, $50, $60, $80,000 in credit card debt, and they didn't remodel anything. They just, were enjoying life. I'll put it that way.
The lifestyle management tool.
Yeah.
Well, we've been talking about your homeowners, let's say under the age of 55. What about senior homeowners? We've talked in the past about, HECM or reverse mortgages. Is now still a good time for them to consider doing something like this?
Yeah, absolutely. I mean, for the senior homeowner, again, if you've got a lot of equity or your home is free and clear, there's a multitude of ways we can help you achieve your financial goals with various products. We've got the standard HECM, home equity conversion mortgage. That's the FHA reverse mortgage. That's the core product. And that can be very helpful to convert your equity into cash, either lump sum, monthly payments for a specific term, monthly payments for your lifetime, or a line of credit that will grow over time, at least the unused portion of that line of credit. Or you can get a combination of those three when you get the loan. So that's an obvious alternative for the senior homeowner in this environment. And of course, the other thing we just talked about on this program, given what's happened in the stock market and people's 401ks have dropped, or people's IRA accounts are fully invested and they've seen the value of their accounts dropping because of the stock swings that have been going on. The HECM reverse mortgage product can be a very useful tool for that, what we call that sequence of return risk, where if you've got an investment account or an IRA account that's fully invested and you've been drawing on that as part of getting money to live on, when you've got your account dropping in value by 10, 15%, that's a time when you want to stop taking those withdrawals and find an alternative way to fund your lifestyle. The HECM reverse mortgage is a great tool to use for that scenario that we're in, frankly, right now.
Are there anything else out there on the that we should watch out for? There are opportunities or maybe gotchas if you're a senior homeowner or a buyer. Anything else we should be aware of?
Well, the thing about it is I'll get inquiries from senior homeowners about getting an equity loan. They're like, I don't want a reverse mortgage, either because they're just not interested in general, or they've heard bad things and they're just not convinced it's a good product to consider. So I'll get inquiries about, from a senior homeowner about, well, I need to tap into my equity and I want a HELOC. It's always a HELOC. And the challenge with that is they're more difficult to qualify for. You do have to make monthly payments. And I think the senior homeowner with a lot of equity, I think they just assume because of all the equity they have that it's going to be easy to qualify for. That's not the case. HELOCs actually can be pretty challenging to qualify for. So those inquiries, when we get them, one of the things I always bring up is if that homeowner is 55 or older, consider, if I can't get you qualified on a HELOC, consider what we call the Home Safe Second. That's a second mortgage product. You're not qualified the same way. You're not qualified just on debt ratio. Plus the fact, when you get that loan, you don't have to make monthly payments unless you want to. And so that can be a very good alternative for that senior homeowner who, needs the money, which can be a variety of reasons. They need to, do some refurbishing. Maybe the home's got some deferred maintenance. They may need to convert the home for senior living. They may have a situation where we've talked about before, they've got a big lot and, the kids are on the couch. They want to build that ADU on their property so that the kid can, that 35-year-old kid can get off the couch and at least have a separate living quarters on the same property. So for all those reasons, either a Home Safe Second or the HECM reverse mortgage can be a very good alternative for that senior homeowner to achieve those goals.
Well, Art, I want to thank you so much. You've shed some light on a lot of things. Again, you've helped us, I guess, demythify the headlines that, the world is not going down the tubes. It's actually, there's the biggest, I think, not surprise, but the most comforting news is how you showed us that the interest rates have been stable now for a long, long time.
Yeah.
And, putting it off is only costing you money, because the other part that has occurred is home equity continues to, or values continue to go up. So if you're waiting, it sounds like with the information you talked about with the information about the rates, we're not going to see any massive drops. And as you said, the threes and the twos are kind of maybe not in our lifetime again.
No, they're not. I'll place a wager, 2.5%, 3% mortgage. Our lifetime, of course, Jeff, we're old people. So,
yeah.
The 25-year-old might say, no, there's an opportunity for 2 and 3 again. I've been in this 44 years. I never saw 2% rates mortgages until 20 and 21. It's not going to happen again in our lifetime. And part of the reason I wanted to provide those updated forecasts of rates from the various industry players, the Fannie Mae's, Freddie Mac's, Mortgage Bankers Association, National Association of Realtors, and so forth, you saw there a very consistent forecast from all of them. Sixes. We're going to be in the sixes this year. We're going to be in the sixes next year. Very likely. I could be wrong. I'm willing to bet those forecasts are going to prove to be pretty darn accurate. And if that's the case, you can't use interest rates as an excuse not to move forward. And the reality is, I'm encountering some prospective buyers, for example, who, all this news about it's the baby boomers who've bought up all the homes, and us, poor 35-year-olds and 30-year-olds, we just can't compete, and we don't have the income, we can't afford it. Well, gosh, I've got a started a loan where, two 27-year-olds making literally, and we're talking about salaried positions, of close to $300,000 a year.
Wow.
Got another one in process where, 28 and 30 years old, and then they're making $180,000 a year. Those kind of income numbers will allow you to buy a home in this environment, even with home prices as high as they are, and with these rates. So I think a lot of cases, people are just looking at the headlines telling them they can't, without taking the initiative to reach out to somebody like us and let us show that they can.
It's time to look in the mirror, folks, and say, I can. And then call Art. His number is 760-969-5023. Art, thank you so much. I'll turn it back over to you.
All right. Thanks, Jeff. Well, thank you, everyone. Thank you for watching and listening to this week's Mortgage Minute. Appreciate it. If you're anywhere in Southern California, hey, don't forget, we got Stagecoach this weekend. Great music festival to check out. And in the meantime, if you don't do that, have a good weekend, and we'll look forward to seeing you next week on the next edition of the Mortgage Minute. Again, my name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.